Greetings everyone, this is Bob Kramer giving you your June economic update. So I wanted to share a little service that we're offering to our community. We are having a shred event this Friday. The shred truck will be at our office from 11 to 1. So if you want to bring in documents that are older than 6 years, usually tax records, bank statements, credit card statements, anything that you would like not have anybody's eyes see but yours, go ahead and bring those in. Also, old instruction manuals can probably be thrown away. I don't think I've ever opened up one of the many instruction manuals to see how to fix something. Everything's available on the internet anyway. So anyway, shred event this Friday, and we're offering lunch from 11 to 1. I wanted to share with you a couple of acronyms that I always talk about when we talk about the economy and the stock market. GDP, which stands for Gross Domestic Product, is the total of goods and services sold within a year. Surprisingly, this past week brought economic news that defied the general prediction that our GDP was going to go down if there are Trump tax tariffs that are coming around, and that has defied logic. Actually, the Atlanta Fed model showed that the quarter two had a 3.8% increase on gross domestic product. That's terrific. So that's the first thing. The second thing I wanted to share is inflation. Inflation has slowed sharply since the Federal Reserve has increased interest rates. So, that has slowed inflation. And what we're seeing right now is a 2.1% on a year ago comparative basis. And that's right in line with the Fed target of about 2%. So investors can be forgiven for being confused. A lot of times you think of tariffs and that's going to do two things. It's going to slow the economy and increase costs. And actually things are pretty well in line for a solid 2025 economically. So as we said before, GDP was largely due to an unprecedented surge in imports. That helps out our U.S. Sales of goods and services, and we're reducing the amount of things that we're importing and spending more on U.S. goods, and that's really good for our economy. We like to focus on the core GDP, which excludes government purchases, inventories, and international trade. Core GDP grew at a 2.5% annual rate, and anything over the last 20 years, our average has been 2.2, so we're above our 20-year average on our GDP. Now, accelerated imports were subtracted from GDP, which is what caused the decline of the GDP in the first quarter. Second quarter really had a robust rebound. The economy was not in massive trouble in Q1 and is not booming in quarter number 2. In the meantime, the fact that inflation continues to decline really shouldn't be a surprise to anybody. We're really trying to get that in check. The M2 money supply has been basically flat. M2 stands for the total amount of cash on the sidelines, money in checking, savings, money market accounts. That has stayed rather stagnant. Net, M2 growth says low inflation. So we're low inflation right now. And none of this means that we're out of the woods for a potential recession risk or an inflation dragon. But I would say that what it does mean that investors probably need to be wary of getting caught up with all the news about the economy, because sometimes that's a little partisan. We're just relating the facts right now, and GDP is good, and inflation being down, that is also good. We are cautiously optimistic about this year in the stock market and the economy. This is Bob Kramer wishing you a happy June. Hope to see you at our shred event on June 6th, and enjoy this beautiful summer weather. Take care.